Welcome back to our IAS number 37 journey of learning. Today, we are going to dive into the equity method, which is a powerful tool for reflecting the performance of your investments when you have significant influence over an investee. And this usually happen when you have associates or you have joint control, as in the case of the joint venture. So to make it clear, before we start this module, the equity method applies if you have significant influence or joint control, meaning that the investee is an associate or joint venture. Now, let's start and see how the equity method works. Not all investments warrant the equity method. You must hold 20% or more of the voting rights in the investees to qualify. Why 20%? This threshold indicates a significant influence, meaning you can exert significant influence over the investee's financial and operating decisions. Think of it as having a seat at the decision making table. However, the ownership percentage not necessarily to be 20% rather than look at the substance of the significant influence. So this is actually what we mean that you have to look at the significant influence and the joint control, meaning that this equity method applies only if you have significant influence or joint control. Now, how the accounting process works for equity method. Unlike the cost model, the equity method is not about tracking historical cost. We don't care about historical cost. But instead, you initially recognize the investment at its proportionate share of the investee's net assets on the acquisition date, because this will reflect the economic stake in this entity. Now, what will happen after that? The magic of the equity method lies in the dynamic nature, and here is how it works. At each reporting period, you adjust the carrying value of your investment for your share of the investee's profit or loss. This means that your income statement reflects your proportionate share of the investee's financial performance, whether it's a profit boosting your income or loss impacting your bottom line. And if you receive dividends from the investees, so these dividends will reduce the carrying value of your investment. Think of it as receiving a portion of your investee's profit, directly reducing your economic stake in the entity. So, if you would like to summarize this in few words, firstly, you are recognizing your investment at cost. Then you are going to update this investment based on your share of the profit or loss. So if you have 20%, so you need to recognize 20% of the profit or loss of the investees, making the adjustment directly to the carrying value of your investment, which means that the carrying value of your investments will go up if you have 20% of the profit or go down if the investees has a loss. So recognizing your share in the profit or loss. Next, if you receive dividends, these dividends will directly reduce the carrying value of your investment because certainly this dividend represents that you receive the part of your profit that you increased before in the first step in the carrying value of your investment. Now, as we discussed before, you need to recognize your share of the investee's profit or loss. And this is calculated by multiplying the investee's net income or loss by your ownership percentage. This amount is then recognized directly in your statement of the profit or loss, providing a more current and realistic picture of your investment's performance. Under the equity method, we have to provide some several disclosures. The first one is related to the nature and amount of your investments using the equity method. As we explained before in the cost method, you have also to explain the nature and amount of your investment. Number two, you have to provide the basis for determining your ownership percentage. Based on what? The ownership percentage you determined based on a contractual agreement. And how did you calculate the profit or loss or your share of the profit or loss? Number three, any significant changes in the carrying value of the investment, including reasons for adjustments from profit or loss and the dividends received. All of these changes in the carrying value of your investments must be clarified clearly or disclosed in a table in order to show how the investment value it changed because of your share of the profit or loss or because a dividend. It is like about a reconciliation. Think about it like a reconciliation at the beginning balance of the year to the ending balance at the end of the year. So you started the year with a beginning balance for the investment in associates, for example, and then you added your share of the profit or loss, or you deducted your share of the loss, and then you deducted the dividends that you received, and then you reach on the ending balance for the investment in associates. So this is how the disclosure works when you have investment under equity method. Finally, if you have information about potential voting rights, so you have to disclose any potential voting rights that you might have in future and your influence over the investee if you have these voting rights. So as an example, imagine that you invest $2 million for 30% stake in a joint venture. Here's how the equity method might play out. In the first year, the joint venture reports a net income of $1 million. So you are going to recognize your share of this profit. So it equals 30% out of this $1 million, which means that you are going to recognize your share of $300,000 as a profit. These $300,000 will increase the carrying amount of your investments and also will be reported in the statement of the profit or loss. So if your investments, you acquired your investments for $2 million, so you are going to increase your value of the investments by 300,000. So it means that it will become $2.3 million. When it comes to the second year, the joint venture makes a loss. So this is another assumption in the second year that the value of the loss is 500,000. So exactly like what you recognize as a share of the profit, you are going to recognize also your share of this loss. So your share of the loss will be $500,000 times the 30%, meaning that you are going to recognize loss equal to $150,000. Now, where you are going to report this loss? First things first, that you are going to reduce your carrying value of these type of investments by 150,000. So previously it was in the first year, it was 2.3 million. Right now it will be reducing by 150,000. So it equals $2,150,000. And don't forget to recognize your share of the loss in the statement of the profit or loss as share of the profit or loss from investees or joint ventures. In the third year, let's assume that you receive dividends of $200,000. Immediately, this dividend that you received in cash must reduce the carrying value of your investments. So the carrying value of your investments was 2150. Right now, it will, after receiving the dividends, you are going to recognize this as 1950, which is 1,950,000. Remember, the equity method provides a more dynamic and informative picture of your investments compared to the cost method. Because you are recognizing your share of the profit or loss, and you are also recognizing the dividend that you received. However, it also requires more complex calculations and ongoing monitoring of the investees' performance because you need to audit and make monitoring of their performance because your profit or loss statement will be volatile and will fluctuate based on the performance of the investees. Think about it. If the investees report a profit, so your profit or loss statement will include part of this profit, your share of this profit. But if the investees' performance go down and achieve loss, so you are going to recognize your share of this loss. So you will find that your statement of the profit or loss going up and down, which means that it is becoming fluctuating because of the performance of the investees. If you have any questions about the equity methods, please feel free to explore in the discussion forum in this part, and we will be able to assist you. Thank you.